So, hello everyone. I'm here today with Steve Cucchiaro. How are you today, Steve?
Great, and great to be talking with you again.
Yeah, thanks. It's great to be talking with you as well, and we appreciate you spending some time with us. So at Three Edge, you have a very risk-off position right now. And so can you take us through the logic of that? Because you've done this in the past and done so in a very interesting way. And so what do you see that's going on right now that worries you?
Well, markets can be asymmetric. They can go up for quite a while, and then when met with adversity, they can suffer a very sharp correction that in a few days can take away many months of gains. And we believe that as the market has now had 3 consecutive years, and by market I mean the S&P 500 index of U.S. large cap stocks, had 3 consecutive years of double-digit returns, we fear that most investors have become very complacent. We haven't had a correction of more than 10% in a very, very long time. And we think that complacency is not justified. The way we value markets is that the S&P, depending on what discount rate you use, is anywhere between 32% and 48% overvalued.
Right.
And it'll take a catalyst to bring that back to fair value. And it's hard to predict when that catalyst will happen. But when it does, I think there are people who are not paying enough attention to risk management and who will be suffering greatly and losing lots of their gains in a very short period of time.
Right. So it is interesting you point out about the last 3 years, because if you had invested at the beginning of those 3 years in the S&P 500, you would have doubled your money. That's only happened one other time. It actually happened for any period of the last 5 years of the 90s. And so it was actually much more dramatic. But you could pick any of those 3 years consecutively, and you would have doubled your money. And I think our observation is that everybody gets pretty comfortable during that period of time. Even if you underperform, it's okay. The returns were double-digit annually. It's really good time. So how do you see this playing out?
So we think that market bubbles can often last far longer than any rational person might expect, but then a catalyst comes along and then you have your big adjustment. And over the last several years, or even a few decades, there have been 2 such catalysts that both could reappear now. One is that the Federal Reserve Board abruptly changes policy, and that's certainly been a catalyst to turn markets down. The second is a black swan, for instance, energy prices. And in the past, when we've had big spikes in energy prices, that caused slower growth, but higher inflation, and that caused markets to turn down sharply. And both of those are present now. We have a Federal Reserve Board that has been speaking loudly and carrying a soft stick, meaning that even though they've acknowledged that inflation is way above their target, they are still, to this day, printing money.
Right.
They're only talking about the possibility of raising rates in March, and that's from a level of 0.
Right.
So we believe that the Fed is way, way behind the curve. Some members are just starting to recognize that, and they may have to act more abruptly than they've been telegraphed.
Do you concern yourself with the political will to the extent that the presidency has some influence over the Fed? Because if we have a correction right now and it lasts into the summer, the House and the Senate are very likely to turn Republican, which would not please the president. Do you worry about that?
I actually have a related but different worry politically, and that is that this administration has been the first administration in a long time to not be pressuring the Fed to try to boost the stock market. Instead, this administration is being pressured in the polls because of inflation. And this administration goes out of their way not to boast about the stock market like the previous administration, but rather is worried about the midterms because of inflation hurting its base. And and the base going out to the gas station and finding gas prices much higher, or the base going out to the grocery store and finding food prices much higher. So I think unusually, there's going to be more pressure politically in the short term to lean on the Fed to fight inflation, to bring inflation down. And but of course, what will happen is if the Fed decides now they have a green light to fight inflation more sharply, that could bring the market down. And there's always a lag before that even affects the inflationary statistics. So
Right.
it could have the adverse effect, like you said, of bringing the market down, which this administration professes isn't so important, but not doing much for inflation until down the road.
Yeah, right. You have a position in India, which is a very interesting position to us. I've been to India. I think it's a very fascinating place. Just tell us what you see in India.
What we see is one of the better growth prospects in the world. Sales per share of the India index is growing more consistently than almost any other equity index we see in the world. And they have a political situation where their election's not until 2024, and it's highly unlikely that they would enact any kind of tightening policies between now and then. Also, their currency has been more well-behaved. Their inflation has been relatively well-behaved. They're not coming from a low inflation going higher, but rather they've had a chronically higher inflation that's been more reasonable. So we think that the growth in India equities can be more sustainable and less connected to China as opposed to other emerging markets that are much more connected to China.
Robert Nutt makes projections of various asset classes 10 years out. As you know, in the decade of the zeros, the annualized return of the S&P 500 was negative 95 basis points annually, which is exactly what he projects over the next 10 years. But he sees emerging markets and non-US as having much more constructive rates of return. How do you see the interaction of those three asset classes?
So when we do our own valuation modeling and we look out 10 years as to expected average annual rates, India scores well, primarily because of its more consistent growth prospects. In the US, when we look at the S&P 500 index, and not other equity indices that are more fairly valued, but the S&P 500 index, our projection, because of the overvaluation that we perceive, when we look at equity risk premiums, we look at expected growth rates, we look at discount rates, we look at a number of very important aspects. And what we see is an expected rate of return over the next 10 years below the dividend yield.
Yeah.
So somewhere in the -1 to +2%.
Right.
I'm sorry, -1 to +1.5%.
Right, right. And what about emerging markets and international stocks? Are you more constructive in those areas?
So from a valuation viewpoint, they're much more compelling than the S&P 500 index, and they've greatly lagged the S&P 500 index and greatly underperformed. So with a mean reversion, you should expect some outperformance. And it seems like the pendulum swings back and forth about a decade or so,
Right.
back and forth. The only worry we have is that in some of the developed international markets, the growth prospects are quite modest. And so some of the better valuations are somewhat justified by the lower growth prospects. And then we worry about China, and China's going through a bit of an internal revolution where they're trying to take short-term pain now, hoping that that's better in the long term.
Right.
But they're going to have to balance what they do. And that's why when we net it all out right now, internationally, the best prospect appears to be India.
Yeah, great. Steve, this is very helpful. We certainly live in interesting times, and it just wasn't that long ago that you had risk off and played that out just perfectly as we went through the beginning of the pandemic. Our hope is that we are at the end of the pandemic and not any reversion in that way. But we appreciate everything you're doing for clients, and we look forward to seeing how this year develops, because everybody should be paying attention. It'll be a very interesting year.
Well, thank you, Kevin. We truly appreciate the relationship with you and with your clients and our collective clients. And we look forward to keeping everyone safe in 2022.
Yeah, great. Okay, thank you.